It's no secret that finance has a considerable amount of ratios. It's also no secret that oftentimes the most simple ones end up being the most effective. Today, I'm going to be pitting two of the most famous ratios head to head to see which is better. Those being the price to earnings ratio, or also well known as PE ratio, and the price to sales ratio, the PS ratio. Without further ado, let's get into today's video. The PE ratio, or price to earnings ratio, is simply the price of the shares divided by the earnings per share of a set firm. The PE ratio is by far the most known and well regarded ratio pretty much amongst all of finance. Anytime you go to a brokerage or a website like Yahoo Finance, if you even look up a stock, along with many other things such as 52-week highs or volume or whatever, the PE ratio is probably going to be there as well. Oftentimes, the PE ratio is applied to not only just individual firms and single stocks, but it's actually talked about in the context of markets as a whole. In terms of what the ideal PE ratio is that many value investors look for, they typically look in the range of PE ratios for between 10 to 20. This is because PE ratios below 10 can oftentimes be attributed to companies that, let's just say, don't necessarily have the best growth prospects, or they're weathering storms, or whatever the case may be. A lot of unattractive companies can kind of reside in this area. Now, occasionally you definitely get some gold mines, but typically a lot of investors again look in that 10 to 20 range. And then of course on the flip side, if you have companies that have a PE ratio of above 20 or so, these might be viewed in the historical context as overvalued. This is because a lot of the returns that come from looking at the PEs actually come in the form of PE expansion. And when it's above 20, these may indicate that the firms are, of course, overvalued. And if they aren't going to grow into this new valuation, then more likely than not, they might contract and end up somewhere in that 10 to 15 range, which of course would result in a loss. Now, on the flip side, introducing our other ratio, the price to sales ratio, this was a ratio that was kind of formed in the 1970s, and then when Kenneth Fisher in the 1980s actually really popularized it in works of literature and discussions around stocks. This ratio, simply put, is just the market capitalization divided by the revenue attributed to that firm. Or on an individual level, it would be again the price of the shares divided by the revenue per share. One of the primary tools of the price to sales ratio that kind of differentiates itself is that it's not only useful in the context of value investing, where mostly the value investors highly emphasize the PE ratio in famous literature, the price to sales ratio can also be used by growth investors. This is because modern accounting principles make it much harder to, let's say, fake revenue or misrepresent it, of course, without committing fraud, than, say, the earnings, where there is a plethora of tools in the modern accounting system that will allow firms to kind of make earnings what they want to, in a sense. Additionally, where the price to sales ratio can kind of stand out is that the PE ratio kind of folds when trying to evaluate companies that are unprofitable, whereas the price to sales ratio is still useful in this context. This is great not only for early companies or companies that are early on in their life cycle, it's also great for companies like Amazon for most of its history, who instead of wanting to try and prioritize being profitable, instead poured all the money he was making back into the business. So, where a PE ratio would kind of be useless in these contexts, the price to sales ratio can still be very impactful. Really quickly, before we get back into the video, I'd really appreciate it if you liked and subscribed to the channel. It would definitely help out with the channel growth, and we've been seeing some positive upward momentum I kind of want to capitalize on to one day achieve my goal of having this channel, well, become self-sustaining in a way. So, thank you very much. Now, in order to kind of determine which is the better ratio to be looking at, let's kind of discuss some of the limitations behind each of these two ratios. As mentioned earlier, the PE ratio doesn't necessarily do the best job handling companies that are either unprofitable or companies with explosive growth prospects. Companies in this sense can change their PE ratio drastically in only a few quarters, and so trying to identify these companies based on PE ratios is basically useless. Additionally, some great investors like Warren Buffett have shared their opinions on PE ratios and have said that common yardsticks like the PE ratio or the price to book ratio are pretty much useless in trying to identify whether or not a firm is undervalued or overvalued, and instead it should be used more or less to show the timing of cash flows for that firm. Simply put, the PE ratio really only shows the earnings of the firm, and it requires a much broader picture to actually be useful. You need to take into account things like the sales or the debt, and of course, the PE ratio isn't designed to handle this well, and that's why it needs a plethora of other information to really be utilized. Furthermore, using common practices in valuation, such as DCF models, you can find that firms that actually have a PE ratio of 10 could be considered overvalued, whereas on the flip side, firms that maybe have a PE ratio above 30 could actually be considered undervalued. So it's kind of hard to determine whether or not the PE ratio can actually differentiate between whether a firm is overvalued or undervalued. To show this, I've actually had Claude build me out a DCF model of Taiwan Semiconductors, which typically trades at a PE above 30 to well above 30 at times. What you'll find is that it doesn't actually do a great job of representing the intrinsic value because, under pretty much any basic valuation model, Taiwan Semiconductors would be considered heavily undervalued. This, of course, owing to circumstances outside of their control, but nevertheless, the PE ratio doesn't necessarily do a good job demonstrating this company's earnings potential. Now, on the flip side, let's discuss the drawbacks of utilizing the price to sales ratio. Very similar to the utilization of the PE ratio, the price to sales ratio doesn't actually show the full concrete picture you'd want. It doesn't show you how well the company actually earns on the revenue it's generating or how much debt it's utilizing to actually get this revenue. Additionally, I'd say price to sales is also a little bit more complicated to utilize than the PE ratio. This is because the price to sales ratio really needs to be utilized when you're comparing firms in the same sector or industry. For instance, you can't just have one set figure of what a good price to sales number would be. Let's just call it 1.5. And then any firm under 1.5 seems very attractive, and over 1.5 would not necessarily be good. Because when you do this, you're going to exclude large sectors of the market that actually have explosive growth prospects that would highly impact your portfolio. Now, obviously, both of these ratios were meant to be used in tandem and amongst a plethora of other pieces of information to kind of pull together this whole image of the firm you're evaluating. But in the context of deciding which is the better ratio, let's just say that you could only have one and the other was completely deleted, you could never use it ever again. For me personally, when I utilize this framework, the PE ratio is a great starting point. But that being said, found significantly more utility relying on the price to sales ratio over the PE ratio in my own personal experiences. For instance, I have limited experience being rewarded hand over fist when I pick a firm that has a PE ratio of 12 versus a PE ratio of 15 versus a PE ratio of 20, etc., etc. On the flip side, when I've looked at companies with price to sales ratios below 1, I've actually had great experience finding success in this and additionally comparing them to other firms in their sector and compared to those price to sales. That's typically where I found more success and returns from the firms that I value, also taking into account heavily the price to sales as opposed to just emphasizing the price to earnings ratio. While my personality really correlates well to the principles of value investing, those coming from Benjamin Graham, Warren Buffett, Charlie Munger, the list goes on. What I've found is that the utility of the PE ratio is really at its strongest when you're looking at mature, stable firms. Now, I definitely love having some of these names in my portfolio to provide stable income and reliable growth prospects, but I'd be lying if I'd say that that was the majority of what my portfolio consists of. Rather, I kind of take after the Charlie Munger approach in the Berkshire Hathaway dynamic duo, where I try and find these fantastic companies at good valuations, not necessarily incredible valuations. And this will oftentimes constitute buying a company at a PE ratio above what is generally accepted as undervalued if you're just looking at what people call undervalued PEs, those again coming in the 10 to 20-ish range. Occasionally, I've gone ahead and bought companies near 30 PE that I thought would grow into it and had great growth prospects. Additionally, I'm not fully opposed to skipping on companies that don't necessarily have earnings. Now, that is heavily dependent on the situation, but in a story like Amazon, where for a significant period of time they were unprofitable, it was because they were making the correct, in my view, management decisions. Where, yes, they could have prioritized having earnings earlier on in their story. But instead, what they did was they basically took all of the money they were making and poured it back into the business. So, yes, they didn't necessarily have earnings in a sense, but they sacrificed short term small gains essentially for a longer term sustainable company that at this point has significant advantages over its peers. So, overall, if I had to get rid of one and I could only have one choice as to what would remain, I personally would utilize the price to sales. I think a lot of the PE ratio utility can come in different ways of evaluating the financial statements, and the truth can definitely be said about the price to sales, but the limitations of the PE ratio kind of hold me back from justifying that that should be the primary measure. And that's not to say I don't love the PE ratio. Again, I've come from a very much value orientated approach just because it aligns personally with me trying to find things and buy things that I believe are undervalued, that have success and track records, as opposed to necessarily jumping in only for growth. Overall, thank you so much for checking out my video. I really appreciate your time. And again, just thank you. I hope you found it somewhat entertaining or insightful or whatever the case may be. I hope you have a great, wonderful day.